Hello, everybody, and welcome to Coffee for Closers. My name's Alex Wellings, and today we're talking all about FEGLI, your group life insurance in the federal market. I'm here with Rick Kallmeyer, Senior Advisor Development Specialist here at Megastar Advisors. We're talking yet again about the federal market, but in terms of one of the most crucial and misunderstood benefits of the federal package per se, the group life insurance benefit. It's one of those things that advisors all across the country overlook when they're working with federal employees, but it is absolutely the number one, misunderstood benefit of federal employees. They look at their life insurance and they do one of two things. They look at it as, it's not really good life insurance. I don't really get how it works. All I know is I heard at the water cooler it was overpriced and not worth the expense. Or they look at it and they love it right now and they know they're going to walk into retirement with this super expensive and kind of flimsy policy. Yeah. So Rick, you've obviously worked with a ton of our advisors in the Fed space that talk, a little bit about the FEGLI benefits, but might not understand everything. So today's goal is to teach as many as possible about the FEGLI benefit, what it means, what are the basic aspects of what's the basic mean, what's option A, option B, option C. Why does it explode on these people? Why do so many federal employees look at it as it is just not worth the costs? And what are advisors suggesting in lieu of their FEGLI as a supplemental option to their FEGLI? And then we'll run through a couple of illustrations, but today is all about educating the masses on it. So, I mean, do you have any particular, before we lay any foundations, do you have any particular issues that come up time and time again when you're talking with FEGLI? What are the common questions advisors talk to you about? Anything like that? Yeah, well, I would just add kind of a point to that. I would say there's a third case in there I see occasionally, and that's the federal employee not knowing that it does blow up. There's a small window of people that they have good coverage, and you'd think, it's almost the mass majority of them, right? Like they don't understand. So you will walk into a few policies that have, a 5-time multiplier. They got all like $1 million worth of face value on their life insurance policy, and it's like $30-$40 right now, and they have no idea that it's going to turn into later. $3,000 a month at age 70. Yeah. So, I don't know, your general or I guess garden variety stuff, one, being able to notice it on the leave and earnings statement, know what the codes are, kind of know what it's talking about, being able to see the deductions, and then just in general, what each option means, what kind of coverage it gives, how it's going to reduce, if it does reduce, what happens there. And then like you said, how to sit down with the client, explain it to them in a proper format, really be able to explain what each thing's kind of doing, and then to give proper advice on how to fix it. Right. So the first thing we should mention is if you have ever dealt with federal employees and you don't even dive into the FEGLI life insurance, you're doing a huge disjustice for them, or you're not giving them disservice. Disservice. Thank you. A huge disservice to them. Their life insurance policy is confusing. It's got a bunch of different nuances, and it's a really great way for you as an advisor to earn credibility with them if you're working in the Fed space. The group life insurance is essentially broken down into basically 4 different sections. Yeah. Right. And we're going to lay those foundations right now. The first of the four is the basic life insurance. Now, Rick, in your expertise, what is the basic life insurance? What do we need to know about it? So the basic insurance is automatically elected to the federal employee. Everybody has it unless you go in and specifically waive the coverage. The code's a CO. That's the most common one you're going to see on the actual leave and earnings statement, or a C0. Yeah, right, C0, excuse me. And it is 1 times your salary, rounded up to the nearest thousand, plus $2,000. That's right. So if you make $48,000, $48,500, they're going to round that up to $49,000 and then add $2,000 to it. Yep. Okay. So you'd end up with $51,000 worth of coverage, and that would be your basic benefit. Yep. And then a lot of federal employees don't realize that as they get raises, the costs go up because their insurance is going up, right? Like the coverage, the face amount of the insurance is going up along with when they hit those tiers. Yep. So essentially, it's a 5-year term. Yep. It's a 5-year term policy, and it continues to. It's an auto renewal, right? So it automatically renews. It is a group plan, so nobody's denied coverage. Yep. You can get it if you want it, and it's relatively cheap while you're working.
Yeah, absolutely.
We looked at it just before coming on. It currently sits at 32.5 cents per thousand, no matter what age you are, a month for the basic policy. And I think we have that here. I'm going to bring this up on the screen. Will you mind bringing this little? There we go. Yeah. So you've got basically, obviously, they're biweekly. They make their checks biweekly. So the basic coverage again is equal to your BIA of greater of your salary, rounded up to the nearest thousand, plus $2,000, like you said, Rick, or $10,000. So if you're like a $8,000 part-time employee, they're going to round you up right to the $10,000 mark. And biweekly costs would be 15 cents or 32.5 cents per month.
Yep.
Okay. And that goes for any age. And if you see here, Rick, it says a 25-year-old active employee and a 64-year-old retiree both would pay the same.
Yep.
And that's partly true.
Yeah.
It's not really the full picture, because the truth is that 64-year-old retiree, once you retire, you're basically forced into a reduction mode.
Yeah.
Not forced.
Forced into an option. I mean, you have three choices you have to take, right?
Right. So let's look at what these federal employees have as an option for their basic life insurance. So if you are an employee at your basic, like we just said, it's $32 or 32 cents, 32.5 cents. And we see that right here at all ages for your basic life insurance, no matter what.
Which is great.
It's great. That's as cheap as it gets, right? But the second you retire, the picture kind of changes. So until the month after your 65th birthday, the costs of the basic life insurance, so if you retire at 60, would be $2.45.5
per thousand
monthly per thousand.
Yeah.
And that really that's if you kept the full, in our example that we had earlier, $51,000 worth of coverage, you'd be paying that 51 times $2.45 if you decided to keep full coverage.
Yeah.
So what a lot of federal employees do is they just take the 75% reduction so they can keep the cost of insurance way down. But they've basically washed out this life insurance policy that they've had for years.
Been paying into for years.
Yeah. And we're going to look at an example here in just a few minutes once we cover the rest of the bases here with options A, B, and C to kind of illustrate what federal employees will typically do, which is the reduction, and why it bodes the case for potentially looking at supplemental or more permanent forms of life insurance that should help a federal employee long term.
Yeah.
Right. So the other options are option A. Will, you can bring that down now. Option A.
Yeah, really easy. Option A is just a $10,000 little kicker, a little $10,000 standard additional benefit.
And it's on yourself, right?
Yes.
So $10,000 extra of insurance on yourself to basically just help with maybe burial costs or something like that. I mean, it's just an additional kicker, but it's relatively costless. It's not a super expensive $10,000 worth of life insurance. In fact, it's just barely more expensive than the basic per thousand. But it does increase in the 5-year increments. Will, if you bring this back up onto the screen here, we've got your costs for an employee of option A. It's the same if you're a retiree, you just don't have the biweekly option anymore. So cost per month all the way up to age 60. So you see that big jump off there. From age 55 to 59, it's $4.33 per thousand for that $10,000, and then it's $13 every year after. And so basically at age 60, people take a reduced benefit and they just let that wash away. 75% reduction on the 10,000 reduces back down to $2,500 worth of coverage.
It's just easy. You're talking $10,000 for somewhere around, $1 to $2 for 20 years. I mean, eventually, obviously you're going to catch up with it if you don't use it, but it's not a bad little additional life insurance policy.
And then we have option B.
Option B is a multiple of your salary, and that can be from 1 to 5 times.
Okay. So if I make $100,000, I'm going to have 5 multiples, or I can have up to 5 multiples, so up to $500,000 worth of additional coverage.
On top of your already $100,000 and now 110,000.
102,000.
102,000, yep.
Because the basic would give me 102,000.
Round it up.
Round that up. Will, you can bring this back down just for a second here. You'd have 102,000 from the basic. Plus, you would have another $10,000 from option A. Yep. And this is while you're working and assuming you're under the age of 65, right? Yeah. We're going to say full, and I kept my insurance intact. So I'd have $112,000 at that point, plus $500,000 more from option B if I took 5 times. Yep. And you can do 1 times, 2 times, 3, 4, 5, all the way up to 5.
Yep.
Right. So $612,000 worth of coverage on myself. And that's pretty much maxing it out. And then option C is what?
That's $5,000 for either your spouse or beneficiaries.
So it's family coverage. Okay, so you can have another $5,000 on yourself, or another $200 or $2,500 on each dependent.
Yep.
Okay. So basically, the life insurance is designed to be a very competitive policy, if not better than majority of solely underwritten, unless you're in really great health, life insurance plans, right? So it's a very competitive plan. The second you retire is when it fails you.
Yeah.
Not to mention it's a 5-year term, so it's constantly increasing, right? So a lot of federal employees will look at their options, whether it be a 20-year term, something a little more permanent, or they'll look at supplemental options for whole life, or for index universal life, or just simply universal life.
Yeah.
And there's plenty of advisors out there that are like, well, I don't want the headaches of underwriting all these policies, getting blood work done. Well, there's plenty to be said about a simplified issue options, right? They're still saving a bunch of money long term and keeping their life insurance policies throughout their retirement.
When they need it most.
When they need it most, right? They're more likely to pass away, and then the life insurance is getting more expensive if they're renewing it every 5 years, obviously. So here's an option to keep life insurance throughout their entirety of their retirement and into their golden years, and basically spending less than they would have if they had kept FEGLI into retirement.
Yeah, and most of the time that's not even, unless you're going to do the reductions, which is a large part, it's more so really the ability to keep life insurance. Because a lot of times, unless you have an advisor, somebody like one of our people, FRC or FEGLI representative, talking to somebody and telling them, hey, look, this is going to happen with your life insurance. Most people don't know it's going to happen. And you only know it happens when you hit 65 and you get that new statement saying, hey, your $100 a month life insurance just went up to $400. And now you're sitting there a day after you turn 65, like, man, I'm screwed. There's no way I can afford this life insurance.
Right.
And, hopefully nothing has happened to you yet where you can still get underwritten and get some cheap insurance.
That's the thing. They end up going to age 55, 60, start to realize, or they get one of these reports done by a federal retirement consultant, and then they end up realizing their life insurance is going to skyrocket on them. And they're like, well, shoot, I've paid hundreds of thousands of dollars in premium into this policy, and it's just going to wash away, or you get 25% of it. Or you
get stuck on it too, right? It's like, if you make it to that point where it's like 60, you've hit that tier and you've been paying for it for 5 years, you hit 65 and it's like, well, I've already been paying this much amount of money in the past 5 years to keep this insurance. Am I going to give it up now?
You almost have to surf, right? I mean, because you're washing away your pension at this point. Let's look at one of the reports. Will, I want you to bring up on the screen here what I've got here. This is one of the reports that we do, or our federal retirement consultants will do as an analysis for those that have FEGLI or anything. They can do a full benefit analysis, but we've just got the FEGLI report here. And this takes into account basically a 55-year-old a 60-year-old that is going to retire at 65. That makes $100,000 a year, to kind of keep with that example we were using, and basically shows this skyrocketing if this client, John Doe, continues to hold on to this insurance. Now, he's got Z5, which is the max package for illustration purposes. It is the basic life insurance, option A, and then B, 5 times his annual salary, and then option C, 5 times on his spouse. I didn't put any dependents in this, but it's just option C. So if you are a federal employee, or if you have a federal employee with a Z5, or just option B at all, or option C at all, or even option A, this would be kind of the case if they kept it. So you look at this person, he's paying $270. You can see that there, Rick, can't you?
Yeah, I can see. I'm with
so $270 monthly for this benefit.
It's not terrible for the amount of coverage he's got.
Not terrible.
$637,000.
Yeah, $637,000 worth of coverage. Yeah. And again, his salary is continuing to go up. He's getting a little raise every year. So you see his basic kind of increasing. That's because he's getting raises every year. And insurance is going to go up. Yep. And basically the next year, it almost doubles because he's going from age 60 to age 61. He's starting into the next 5-year term, which would be starting at 61. Okay. And then at the ripe old age of 66, which would be the next breaking point, you see he's kind of moderately going up, 567 right here, then 588, 603, 618.
Again, going up with the raises.
He's going up again with the raises of insurance. The cost of insurance isn't increasing again. It's a 5-year term. But then he hits that next threshold, $964. And he's retired now at age 66, right? So he's starting into retirement years. So he's starting to hit those new tiers with the basic coverage. So the basic is starting to cost him a little bit more. Yep. And we had that up here. Let me show you guys again. The basic coverage for an annuitant, which would be a retiree, changes for this person if he's going to hold on to it at the age of 65. So a month after your 65th birthday to $2. So from the $3.20 or $32, right? So let's look at the employees. 32 cents, 0.5.
32.5 cents.
Monthly. Now for the annuitant, after the age of 65, which is the case of our illustration, it's $2.13 monthly. Much more expensive per thousand. Okay. So $964 monthly.
Yeah.
And so if this is a guy that makes $100,000 and he's a FERS employee, that's almost half his pension, might be more depending on how long he's worked for the government.
Absolutely.
Right. Like it could be a huge
if you've only put in 10 years or like 5 years or something like that, I mean, your pension's going to be paying for this life insurance.
That's right. Yeah. And then what's going to happen by the time he hits age 75? Yeah. Geez. Almost a third more, right?
Yep.
Almost a third more.
So again, expensive. I'm talking you've suffered through 60 all the way to 65, paying $500-$600 a month for life insurance. You hit that 66 point, now you're looking at $1,000 a month. You know, you're either going to give it up or you're going to continue fighting it if you have enough money to possibly fight it.
So let's say you do have enough money to fight it, right? And then the next 5-year gap, right? So if you're an average American, you're going to make it to age 86. By that time, you'll be paying $3,600 per month to keep that life insurance policy. And in almost every case, by that point, if you look at these charts right here that we have, this is the annual premiums by age. You'll have paid more into this policy than you're ever going to get out of the policy.
Yep.
And that's the shocking realization of a lot of federal employees is they're like, wow, I've paid so much. So look at here again. By age 86, I've paid over $500,000 worth of, or almost $700,000 worth of payments into the policy. And by that same age, I'll still have just over $600,000.
You just put it in a bank.
So you've basically made a wash into this policy. Yep. And for the years going up to it, it would have been basically a wash anyway. You would have been better throwing that into an interest-bearing account your entire life. And okay, I get that. That's fine. That's kind of the risk of life insurance. Life insurance is protect against dying too young. And while you don't have assets, and now here's this 86-year-old person that's put so much money into a life insurance policy. Okay, fine. But it didn't have to be that way. You could have had your cake and eaten it too.
If this was the only life insurance policy in the world, it's not a bad move, you know?
No, it's fine. You know, okay, you've paid so much into the policy and you didn't have to, you didn't have to worry about money.
You're playing the house and you lost,
right?
Essentially.
Yeah, you're playing the house and you lost, but fine. You broke even on the policy. Okay. But you could have had better supplemental, there were better supplemental options out there that would have let you have your cake and eat it too, have some potential cash value. You could have had more living benefits. You could have had a policy that doesn't break the bank in the years when you don't have the ability to earn more income, right? And that's all because they've bought life insurance essentially from the government rather than buying from a company that specializes in life insurance. And so it's an easy education for federal employees that are like, well, here are your two options. You've got this situation where you keep all the life insurance and it explodes on you, which is almost every time just nope, I'm going to walk.
Yeah.
Right? Or this other option. We'll bring this up here. This is the more likely scenario. So here's a 55-year-old that is paying into a policy And by the time they're age 65, they're going to cancel their policy. They're going to do a reduced paid up, right? And so you see, they've got like this gap period here where the face value starts to reduce, but they're not going to pay any more premiums. So it's a reduced paid up life insurance policy. But by the time they're age 70, so if they make it to age 70, they've now paid accumulated premiums of $64,000, and they've paid out $36,000.
Yeah,
if you've now paid in. But if you make it to 70, so sure, if you're making out like a bandit, if you died between 63 and 70, right, or 65 and 70, or really any time before 70, you've made out like a bandit on this policy.
Yeah.
But if you're like most federal employees or most Americans, you're going to live past that to age 70, and now you've got this life insurance policy that you've paid $64,000 total. Again, that's this number right here, accumulated premiums. And I've only got $36,000 worth of death benefit to show for it. It's become a burial policy at that point. Reduced paid up, which is fine. Okay, fair enough. Again, life insurance is to protect against being too young. But here's a policy. A lot of federal employees have troubles seeing that they've paid so much into this policy and it's just going to disappear. And they don't, like you said earlier, they don't know anything about it. They didn't realize that it's just going to disappear on them if they do that. So it bodes the opportunity, or it creates an opportunity for an advisor to sit down with them and say, hey, look, there are other options out there where you could potentially have a life insurance policy that gives you a death benefit, either similar to the $36,000, and creates a death or a cash value that you can use to take loans from, which would be tax-free distributions. You could create a cash value to just take distributions from. You don't actually have to take the loans if you don't want to do that. Or you could just buy a more permanent form of life insurance that has some cash value but has a much bigger death benefit, or has no cash value and has a much bigger death benefit, but the payments stay level.
Or it's going to continue to cover you until you die.
You die to age 100. You know, some people will, if they have outside assets, consider talking to them about, making those other assets, put them to work with it, do a 10-pay life insurance, 5-pay life insurance, and put together some prepaid life insurance policy that'll help them long-term, whatever.
Yeah,
right?
Absolutely.
Stay funded through the cash value. There's so many different options, but this is what the federal government's offering them, which is either doom and gloom from it's going to cost you so much for this life insurance policy, or basically a life policy that's going to fail you exactly when you retire.
Yeah, I think that's just their understanding, in a large part, their understanding of the actual life insurance and it as a conceptual tool. For 40 years, you look at this life policy, and let's say they do understand that it's going to blow up on them by the time they actually need it. You're not going to cover the insurance, because most of us look at it and say, well, I'm probably not going to die in 10 years. Nobody really looks at their life and says, I'm going to be the one that goes. So a lot of these people, if they're not going to cover it, they're not going to take care of it, and they don't understand this more advanced life planning things of like, hey, we can build, like you said, cash value in this policy, or we can truly cover you, because they don't understand that life insurance has developed more than the 1960s and 70s. There's a lot of cool tools we have now that can really help out.
And it's a great way to, if you're dealing in the federal market and you're looking to potentially talk to somebody about their TSP and it's not the right time, 55-year-old, 45-year-old, something like that. It's a great opportunity for you to make them a client and then potentially talk to them down the road about other options with their other benefits. But I know what the question's going to be that we're going to get from this episode all the time. I already get it all the time anyway. It's no different than any other employee plan, which basically other employee plans are just going to boot you from the policy the second you separate from service anyway, right? It's not going to, you don't even have the option to continue it on through retirement, right? And they're like, oh, well, that's it. Well, they also haven't been fooled into thinking that it will, right? So if you started with Bank of America yesterday and you work for the next 30 years with Bank of America, they're not having told you that you're going to have this life insurance policy that'll continue through your retirement and it'll keep you covered. They're telling you that it's a life insurance policy that's good while you're here.
Yeah, while you're working here.
While you're working here. But the government, the federal government, makes the federal employee think that this is a life insurance benefit. It's a benefit that's not only while you're working, but it's a retirement benefit as well for them.
It's a really good point.
Right? So they think that this policy is going to last them forever. And so they're buying it thinking that it's a permanent form of life insurance, which it is. They can continue to get coverage with it no matter what.
Yeah. How much coverage?
Well, they can get this coverage, right? Like they can get this coverage and they can get it guaranteed no matter what their pre-existings are.
Yeah.
So the only people I really suggest keeping this FEGLI life insurance are the people that are, have pre-existing conditions. They can't get any other life insurance.
Yeah.
But for a young federal employee or for a middle-aged federal employee, looking at permanent options is almost always a better option for them. It's like, hey, look, I know you're thinking about buying this FEGLI life insurance, but you need to consider your supplemental options before you do so. Reason being, you could potentially have a much or a similar cost of premiums today for the rest of your life that won't explode on you in your retirement years like FEGLI. Let me show you what's going to happen.
Long term, absolutely. And looking at that first case, I mean, if you put $600,000 into like an IUL or UL, I mean, I think it'd be a monster.
Oh, it would be a monster, illustration-wise, and we don't know what the indices would do or whatever, but it would most definitely outperform what FEGLI would give you death benefit-wise, right? If you took $600,000 and you spread it over, if you bought a 20-year term, you'd be buying more life insurance than...
Yeah.
I mean...
It's dollar value.
Yeah. So that's the group life insurance, right? This is a no-brainer opportunity for advisors to help federal employees out there. There are so many federal employees that are confused on this, and the second they learn the truth about it, are having a eureka moment, and it's an opportunity for y'all to build credibility with a group that has been sheltered from kind of the truth and maybe misled, unintentionally misled about the truth of their benefit.
Misinformed,
right? Underinformed.
Yeah.
Right. So that's it for everybody here on Coffee for Closers. I'm Alex Wellings. This is Rick Kallmeyer. We're here every week teaching everyone out there about the nuances of our industry. If you like what we're doing here, please don't forget to like, comment, subscribe, share, whatever it might be. We appreciate all of that, and we'll see you next time right here on Coffee for Closers.
Thank you.